right on time, and we start talk about important topics. And we have people coming into our firm and with a letter, with a poster, with marketing materials from other companies saying that, hey, you qualify for a lot of money and get it fast, otherwise you lose it, and we can help you and with 25% of your refund. So those kind of marketing materials draw your attention because that's a big dollar amount, and it is called ERC, the Employee Retention Credit. So today our topic is review, refresh, and rediscuss about this credit. Okay, so that's our webinar today. Let's get going. And what I want you to know is that I'm also an author, and I wrote this 8 a.m. appointment with Ying at 8 a.m. book. This is a startup business book, and I just finished another one. It's called Appointment with Ying at 10 a.m. Right now, this book, I finished it in February, and so it's with publisher, and it will be published this year for sure. So this book is about growing your business. So after you establish the business, you grow. So logical, right? So I have 2 more to go. 2 p.m. That is appointment with Ying at 2 p.m. for merger and acquisition. Then I have a 6 p.m. retiring from your business life, right? Business life as well. And no responsibility disclaimer, so important. Whatever you got from the internet, take it with grain of salt and making sure that you digest that for your special situation. Don't just believe what they send to you. Don't believe that flyer come to your door, says that you have $1 million ERC that you need to claim. And you can be curious because of that. So study whether you are eligible, whether that is your cup of tea, right? And we say that we don't drink other people's cup of tea, only ours. And getting government money is not a joke. And if you are receiving government funds, you need to have that shoulder on your, you need to have your shoulder ready to take that burden. And when times to approve it, you need to be 100% confident that you are eligible, you are entitled to the amount of money that you claim. All right, so a very important timeline I want to give to you, because most of those notices you got, you know, the posters you got, they say that, oh, if you don't hurry up, don't call me in 3 days, and you're going to be losing the credit. So the credit, you still have time. So here I give you example. At least 3 years from April 15 following the ERC eligible year, not by the quarter. So if you want to do 2020 ERC claim for all your quarters, okay, quarter 1, quarter 2, quarter 3, and 4 for 2020, and you have up to April 15, 2024 to submit that in. So that is your drop dead deadline for 2020. So in other words, you have time, right? 2020 is the first year you can claim ERC, then you have 2021. So therefore, your 2021 will be April 15, 2025, yes. So you do have time. The rest of the items here is what I'm going to cover. I'm going to give you the IRS warnings because you want to know what IRS say to you. And I want to give you a quick summary of ERC summary, eligibility talk, and the credit amount, claim procedure, and the common mistakes. And I hope I can run through this with you, clear, simple, and I want you to get it. So you can say that, I know what you're talking about, and give you enough information that you can protect yourself, do it yourself, or hire consultant to get that done, hire CPA firm like Community CPA to get that evaluated and completed for you. All right, IRS warnings. So October 19, 2022, IRS sent out a warning saying that employers warned to be aware of third-party promoting improper employee retention credit claims. You see, IRS know that some of those posters you're getting is improper. And you probably wonder, why do they just shut them down? Why do IRS let them do that to us? Because making us so confused. You know, these people, if you really drill them down, they may not even be in US. So it is really difficult for IRS to stop them to give you those posters, but it is your responsibility because you live here and you are running your business here. So you are the one who really need to be aware of what's going on. And in March 7th, 2023, IRS issued renewed warning on employee retention credit. And it says false claims generate compliance risk for people and the business claiming credit inappropriately. So IRS goes, you know, these kind of fraudulent claims will get you compliance reviewed, and then you spit the money back out, and then you get penalized. So there is a paragraph here. I'm not going to read it to you, but I am telling you that the acting IRS commissioner, Doug Donnell, and he said anyone who is considering claiming this credit need to carefully review the guidelines. So that's what they're saying. So if you say, well, I claimed it wrong because I don't read English, forget it. That's not excuse. Then you say, well, I claimed it because the other party told me to do that. I did it and they did it for me. Not excuse, because they are not signing it for you. Folks, when you have people who promise you a fortune and then paperwork came out and make you sign for it, you know that's not a good sign, because that means they're saying, I'm just doing it for you. I just typed the English word and number for you. You're the one knowing what you're doing. You're the one endorse this claim. So all responsibilities on business owner. So small, medium-sized business owners, I know you have limited experience, but just know that when we get money from the government, we want to make sure that we button down, we put our ducks in a row, and you are qualified to do it, you get it, then you can sleep better. All right, so that is the IRS warning side. ERC summary, just really quickly. ERC is employment tax credit. So basically the IRS says that if you have qualified on certain ways, and we give you your 941 money back. So that's very simple, just like that, okay? So here, eligibility in a quarter, March 13, 2020 to September 30th, 2021. So we are crossing 4 quarters in 2020 and 3 quarters in 2021, okay? And if you suffered significant decline in your gross receipt or had full or partial business suspension due to compliance with government COVID orders, folks, not imaginary COVID orders. Oh, I just want to close my shop because I am worried about my employees' health. Good cause, but it's not government order. And the government order includes the federal, state, city, county, any government. Okay, doesn't include nonprofit, right? So that's not government. Doesn't include association, not government. So government has to be a publicly elected entity, right? That's how we do it here in the United States of America. And what about a government order from Germany? What about the government order from China? Forget it. They are not your government order. So their ordering shutdown has nothing to do with you. So that's not a government order. All right. So eligibility in third quarter, fourth quarter of 2021, and that is specific for qualifies as a recovery startup business. So there is a separate category called recovery startup business, and you can claim. Okay, we do more talk later on this one. So ERC amount is 50% of 2020 qualified wages or 70% of 2021 qualified wages, including allocatable qualified health insurance expense. What does that mean? You know how sometimes you withhold health insurance premium from the employee portion. For example, at Community CPA, we have group health insurance, but 80% is paid by the company and 20% paid by the employee. So the employee portion, the company paid portion, of course, can be included in the claim, but the 20% of employee portion that the employee paid in their payroll, that is also come out of their payroll, but pre-tax. So that can be included as well. So there you go. So that's your health insurance, right? 2020 annual qualified wages capped at 10,000 per employee. 2021 quarterly qualified wages capped at 10,000 per employee. So in Q3 and Q4 of 2021, recovery startup business quarterly ERC capped at what? 50,000 in total. So I know it is a lot of verbiage, is a lot of noises, and for you, you are like, so what is mine? What is mine, right? So you want to kind of generally understand the qualified wages and how you calculate that, and then you have this maximized the maximum amount to qualify. So here, that summary, ERC summary continued. Qualified wages are wages paid during March 13, 2020 to September 30th, 2021. So this is what? This is like the 4 quarters in 2020 and 2 quarters, 3 quarters in 2021. Okay, and so these are qualified wages. And for recovery startup business, the wages paid from July 1st, 2021 to December 31st, 2021. But of course, the following things has to be out, and it is exclusions, certain exclusions. So number one is the amount of wages, maximum is 10,000 per employee in 2020 for the whole year. But 10,000 per employee in 2021 is per quarter. Okay, so, but over that, excluded. Wages paid by PPP and sheltered event program, and also RF, those cannot be counted as ERC qualified wages. So if your wages is already paid by PPP, forget it, that should not be qualifying wages. Wages paid to relatives of majority owners. This is the area that later on I mentioned is the most common mistake area, because majority ownership is not like, oh, I husband and wife run a company. I have 51%. My wife runs 49%. So I'm the majority owner. No. So not your salary need to be excluded, and also your wife's salary need to be excluded, because majority ownership is measured by constructive ownership. This is a legal term. Trust me, I never desired to be a lawyer. Only my daughter is a lawyer, so I don't want to be. And constructive ownership and means that the ownership by legal definition in this particular case is combining ownership of spouses, so your significant of others, ancestors, and your linear relationship bloodline, and the linear dependents and the siblings. See, it's very wide casted net. So if a business owner and with a spouse own the business, and one of the owner's brother is working there, then all 3 of you are considered majority owners. So your wages cannot be used to calculate. And the wages paid by large employer to employee performing services cannot be included, has to be excluded. What that means is if you are a large employee, which you are a large employee, the definition is right there on the bottom, and I'll go there. So if you're a large employer, you can only calculate ERC on the people who didn't work, but you paid them. But if they worked, you paid them, that's not ERC. So the large employer definition is greater than 100 employees in 2019 for 2020. So for 2020 ERC calculation, if your employee is greater than 100 of them in 2019, you are already a large employer. But for 2021, if you have more than 500 full-time employee, you are considered larger employer. So if it is under 5 for 2021 ERC claim, and you qualify. So let's say if you are employer with 200 people, then you don't qualify 2020 because you're too big, but you qualify for 2021 because you're not that big. right? Okay, tell me about why they have to make it so complicated. I am pretty sure the purpose is that to make community CPA very famous. So you don't have any other way to get away from this. You have to come to us to get a consultation done. And I'm so sure that was purpose from the Congress, not, I don't know why they do that, but those details really requires a, a professional person to get that nailed down for you. So these are qualifications you want to know to make sure that you qualify before you even go for the number. Because once you got the number in front of you, and it's pretty attractive, right? If someone tells you that you can have a $104,000 refund by just signing up this form, you get it. And, I know the temptation is there, but qualification is, eligibility is so important. So there's another thing called aggregation rules. This one applies to you when you, as an owner, own other businesses. Be very careful with that. You want this to be studied before you apply for ERC, because you could be totally wrong and you should not be applying for it, but you apply for it. Or maybe you should apply for one, but you applied for 5. So just make sure, and this aggregate rule is in your radar, okay? And total ERC calculated by 50% or 70% of quarterly qualified wages. That's my third bullet point in here. So those are just mechanical. Those are numbers, 50% in 2020, 70% in 2021. And the math side, I'm telling you, if you are doing ERC, you already getting on to doing math, you're done already. Math is not hard. But what is hard to understand whether your business qualifies. The employer will get total ERC back, okay, if employer already paid 941 taxes. So this is just what we want you to know. If you apply for ERC, but you never paid your taxes, what you did is just kind of wiping out your tax liability. You don't get a check. But if you already paid your 941 taxes, then you get a check, okay? Simple example. People like examples when we do webinars. So 5 employees unrelated to majority owners. So let's say they got 7 people working in the company, husband and wife, they're gone, they cannot qualify. So 5 employees unrelated to majority owners, each was paid more than 10,000 qualified wages in 2020, okay? More than 10,000. Then 2020 ERC would be 25,000. This is assumed no PPP. How did I get that? 5 times 5,000, okay? And the 5 employees unrelated to majority owners, each was paid more than 10,000 qualified wages in first quarter of 2021. Then the first quarter of 2021, they will be getting 35,000. Why? Because 5 times 7,000. That's where that calculation is. So a lot of times when you see the flyers coming to your door, what they do is they actually knew how many employees you have because they probably bought some database from some payroll company. And this is another thing. Majority of the people, when you receive these kind of notification, and I will just say that you probably are doing payrolls with some large franchise, with large companies, because data went out, got sold. So they know you have 5 employees or 7. Because they don't know your other 2 people are majority owner, so they probably do 7 and times 5 for you, saying that, hey, you can qualify 35,000 in 2020, and then they do, 7, they do 49,000 because it's 7 people times 7,000, 49,000 each quarter. They tell you you qualify for 3 quarters, so you got a big number in your flyer, but that doesn't mean anything. It just means that's what if kind of scenario, right? All right, so now here we're talking about determination of ERC, eligibility, eligible quarters. So you don't have to qualify for every quarter, but you could qualify for 1 quarter, okay? So that's why the eligibility is determined by quarter. Eligibility is not something or you look good, so your company qualified. No, it is a looking into by each quarter. So businesses that began operating before January the 1st, 2020, and in operation in 2020, 2021, suffered significant decline in quarterly gross receipts compared to same quarter in 2029. Okay, significant decline. And this one, that there is a number to it. For 2020 is 50%, for 2021 is 20%. So the government gave you the identification, the real numerical number to tell you what means significant. And number two, okay, number two, the government COVID order fully or partially. I know I have a backslash here, but you can interpret that to be or partially suspended the employer's business operation in part or entirety of the quarter. You see how everything is measured by quarter. So if someone doing eligibility study for you, it is not by year, it's by quarter. Small business that began operation after February the 15th of 2020, you are a recovery startup business. That small is underlined because it has a number tied to it, okay? Automatically eligible in quarter 3 and 4. If you are a small business that began operation after February the 15th of 2020, you are automatically eligible for quarter 3 and 4, 2021 ERC claim. All right, so significant decline. Now we explain more. 2020, 50%, okay? 50% until after the quarter in which your gross receipt recovered to 80%. What does that mean? That means your last qualified quarter in 2020, that can be already recovered, but it says after. So allow you to have that quarter that you already recovered more than 80%, you can still claim. So just remember that. So we made it red so that draw your attention. 2021, that is 20%, okay? And after you come back in, if you have a quarter that you're 20%, you declined by that much, then your following quarter is called alternative quarter test. Your following quarter would automatically qualify. Just rules, right? Just rules. Just hear me really clearly. It is not straightforward that, oh yeah, if it is less than 50, I qualify. And if it is more than 50, I don't. No, maybe you do, because that is until after the quarter in which gross receipt recovered to 80% or more. And for your 2021, yes, you got one quarter went down, the second quarter is alternative quarter, so you automatically qualify. Okay, small recovery setup business, the small means your average annual gross receipts for the past 3 taxable years did not exceed 1 million. Average. That means if you open up your business in 1 year just for 1 quarter, I know you don't over 1 million, but you have to annualize that year. Then add up your other 2 full years. You annualize all of the years. Then divided by 3, you have less than 1 million. That is how you qualify, okay? All right. So ERC credit amount for 2020. And very quickly, March 13, 2020 to December 31st, 2020. So this is, a piece of first quarter and the full second, third, fourth quarter. 50% of the quarterly wages, 2020 annual qualified wages is capped at 10K per employee. So maximum is 5K per employee, right? And 2021 maximum credit for each quarter, ladies and gentlemen, not a year, 7K, right? That is from January the 1st, 2021 to the third quarter ending September 30th, 2021. All right, now for this recovery startup company, and July 1st, 2021 to December 31st, 2021, 70% of qualified wages, quarterly qualified wages is capped at 10K, okay, per employee. So 50,000 maximum, 50,000 maximum. There's no other number more than this for the startup recovery business. Okay, example. Always good for example. Wages of 3 employees in company ABC per quarter. Okay? So 5,000, 10,000, 15,000. So this is a 3 employee. Gross receipt dropped in the first quarter of 2020 compared to the same quarter of 2019. So compared to 2019, first quarter dropped 10, second quarter dropped 55, third quarter dropped 30%, fourth quarter of dropped 18%. So what's the eligibility? Quarter 2 eligible. Quarter 1 didn't drop enough. We need a 50%. So quarter 2 eligible. Quarter 3 eligible. Quarter 4, it didn't drop 50%. And but why is available? Because this is after your quarter 4. Then it won't be eligible, but right now it's eligible, right? So with that said, we come into calculation 5,000, 10,000, and 15,000. So the 15,000 is capped at 10, so that's why it's repeated as a 10,000 here. So this is your maxed out for the 2 employee already. So your 10,000, because the annual number is 10,000, right? So it's maxed out. So when we calculate it again in here, it is already 0, even though fourth quarter qualified, but it's 0. So we got total ERC is 12,500 plus 2,500, and that is assuming you did not get PPP. All right, 2021, same example, and the gross receipt dropped in each quarter, 2021 compared to the same quarter of 2019, again, comparing to 2019. So quarter 1, 25% drop. Okay, 22, 21% drop. Quarter 3, 15. But quarter 3 also qualify. Why? It is alternative quarter test from quarter 2. Because quarter 2 qualified, so quarter 3 qualifies. It doesn't matter it dropped less or not. So there it calculates. So quarter 1, and you got 3 employees, 70%. So we got this number. Quarter 2, we got this number again, and the quarter 3, we got $17,500 number again. So that is your qualification for 2021. Very different ball games. I mean, you just have to really understand that. If this is getting you overwhelmed, confused, folks, just go for professionals. Get them to do the work for you. Those calculations are not hard. What is hard is to come up with which quarter that qualifies. So ERC eligibility study. All right, procedure, so simple. You claim that right now we are already in 2023, so I'm so sure you already paid your taxes for 2020 and 2021 940 taxes. So you just file amendment to do that procedure. Simple, right? So that's what I want you to know. Claiming it is no big deal. People can give you a form, you sign, you got it. IRS gave you the money and whatever you claim, as long as you pay taxes, but that doesn't mean you have the money, because eligibility study is really a key. You want to make sure that you get that done, button down. So common mistakes, that's where I want to drive your attention. I want to wrap up today by mentioning these common mistakes to you. So there's 4 of them. Number 1 is it is the double dipping on other federal programs. So ERC is a federal program, and you want to be very cautious not to claim the wages twice or 3 times using the same wages for different federal programs. So wages paid with proceeds of some other federal programs beside PPP cannot be accounted as a ERC qualified wages. Does that make sense? That makes sense, right? So common mistake we talked about no double dipping, just because if you do use the same wages to claim different federal program, they will come back on and to do compliance review on you, then you will have to spit that dollar back to them. Okay. Aggregation rules is a big deal. And if you are a business owner, you own multiple businesses, you might be subjecting to aggregation rules. So this is one of the eligibility that people really need to do a professional job for you. And if five or less individual, directly or indirectly, collectively own 80% or more of two or more entities, these entities form a controlled group. The concept is very similar to the retirement setup. Like when you set up a 401k plan for your business, you probably hear your consultant talking about controlled group. So that's similar to that. And example we give you is the partnership A is owned by C Corp and B. So the partnership A is owned by C Corp B, C Corporation, just called B, C Corporation B. And the C Corporation B is owned by husband and the wife. Okay, so just think of that. And the S Corporation D is owned by husband and wife as well. Now, A and D is constitute a controlled group. Did you kind of see? So it's landed on the individual. So let's say you are husband and wife, you own this company, you also own the other company, you also own another company. When considering ERC claim, these are aggregated rule applies. You might be a controlled group, so you cannot be claiming ERC on each EIN number. You may say that, well, but I have an EIN number. I pay different 941 for every company. It doesn't matter. So there is a test called aggregation rule, and to test to see whether you're a controlled group. If you're a controlled group, it has to be combined. So it has to be looked at in the collective view before you can claim. So this is a very complex situation. We just want to bring that to your attention. If you are really belongs to this category, folks, don't do ERC claim on your own. Come to Community CPA to get help before you get on the journey to get a refund. You may not qualify. Okay, so I just want to, this is a common mistake. This is number 2 common mistake. Number 3 common mistake is constructive ownership. This one, we sort of touched on that already, saying that, constructive ownership, majority ownership doesn't mean you own 51%. Majority ownership means under constructive ownership concept, you are a majority owner. But you are a majority owner, don't need to own majority of the shares. That makes sense. So example, 3 siblings, ABC, own a company. So 1/3 ownership for each, right? So this one is an IRS example. So A is an employee. B and C are not, but B's son is an employee. And in this case, ABC are all considered 100% majority owners, combining their ownership. Like, the majority is actually all 3 together. So they're 100% ownership for each one of them. The wages of A and B's son need to be excluded from qualified wages. Did you see where I'm going on this one? So 3 siblings owns a company, 1/3, 1/3, 1/3. And A has salary and B's son has salary in it. So B's son's salary need to be excluded as well. So that is what constructive ownership guidance inside of ERC. And a lot of times when the third party, those credit people, not a CPA firm, they're just there doing this for you. They don't even ask you those questions, but you need to know, because if you get compliance reviewed IRS will ask you that question to figure out your constructive ownership structure. And then exclude people probably who got paid the most out of your ERC calculation. Not good, but you need to know ahead of time, right? All right, another common mistake, which is applying the government COVID order criteria. This is very interesting. So was the closure or partial suspension due to a specific government order or not? That is the key. So people say, well, I closed my company for, the full quarter, and I closed it because CDC said that it's recommended to do that. So I did that. But if your state doesn't believe in COVID, like President Trump did, then you don't have a government order. Then you don't have a reason to close, even if you close for good intention. Okay, so if you choose to close temporarily for your and the employee safety, but are not so ordered, then the government order criteria doesn't apply to you. This is IRS example, right? Supply chain issues. We come across a couple of people who got those flyers come over to us and said that I have supply chain issues because I couldn't buy anything anymore, so I shut down my business for a little bit. So, but the key is you can only use this issue as a reason to claim ERC if it is caused by specific government order. So IRS examples to say is that your supplier in another state was ordered to temporarily close. So yes, maybe, if your suppliers in California, the government order closed. So here you are you're in Florida, and the state doesn't believe there's a COVID, then you could use that to be a claim because California closed, right? So that is caused by a specific government order. And, IRS example specifically said supplier in another state. So what about suppliers in China? China, of course, closed down, but that do not constitute our regulation, our things here as a specific government order. Chinese government is not a government here. The government order here means the US government, US city, the US county, the US jurisdiction is not related to overseas. So if Germany closed, Mexico closed, China closed, so you don't have your suppliers, that is not a reason for supply chain issues. So that's not your eligibility. In a non-nominal portion of your business operation, is non-nominal portion of your business suspended due to government order or not? That is a very loosely defined qualification, but let me just give you what we understand. So your business operation suspended due to government order, and the IRS says that if it is if it is greater or equal to 10%, that's the definition of non-nominal portion. Okay, so you have to define that your operation is affected by government order and greater or equal to 10%. So then you will ask me, well, what do you mean by business operation? You got to have a mean to define your operation shrinkage by 10% and due to government order. So those are qualifications. And a further detail to talk about that, I would say that you really need, if none of these things you qualify and you think you qualify for the non-nominal portion of your business operation rule, you need a consulting work done before you go ahead to apply. All right, the last one, but really not the least. This one is also a common mistake with ERC on non-refundable portion of your ERC for 2020. For 2020 quarters and the 2021 quarter 1 and 2, so complicated, right? Because those 2021, you can go for quarter 3, but just for quarter 1 and 2, employer portion of Social Security is non-refundable. Okay, and the refundable and the non-refundable, what's the difference, folks? I have webinars talk about these things. So non-refundable tax credit means that if you never paid for it, you won't get it. Refundable means that even if you didn't pay for it, and you can get it. It is like, you can think of refundable, non-refundable, think of refundable ones like a ERC, like a earned income tax credit. You make so little of money, you don't even pay taxes, but when you file 1040, you got a bunch of refund. So that's a refundable. But non-refundable means like your part of our child tax credit is non-refundable. Like if you paid taxes, they give you the child tax credit. If you didn't pay taxes, they don't give you that portion. So that non-refundable just means that you have to be paid. You paid it, then you get it. Otherwise, you don't. So that is the rule related to 2020 quarters and 2021 quarter 1 and 2. So when people do calculations, and they need to manually know that. Otherwise, they're not doing it right. So want to bring that to your attention so you know the calculation is not as straightforward as you want it to be. And for 2021 quarter 3 and 4, remember, and in the quarter 3 and 4, those are the recovery small business, and those are employer portion of Medicare is non-refundable. So that's a special rules as well. Non-refundable, refundable portion are partitions of, not in addition to, the total ERC amount, calculated as a 50% in 2020 and 70% in 2021 of a qualified wages. And there is really no cookie cutter for you to say that, okay, give me a form so I know this, how to do that, because you may not have those quarters as a qualified to begin with, or even if you have them all qualified and calculating, it depends on how you filed your original one. So getting that calculated and knowing there is this non-refundable portion that you need to pay attention to is very significant. So I want to go back to these 4 mistakes that we talked about, and just simply draw your attention so you know what you're looking for. So number 1, double dipping funds. So you want to make sure you're not double dipping federal funds and not excluding certain owners or relatives' wages, or excluding owner or relative wages unnecessarily. So this is like the constructive ownership concept. It is not equal to the business ownership. So just so you know, okay. The third one, non-refundable portion, and that is something we talked about. It especially for quarter 3, 2021 is not the same animal. And then making sure that when you calculate each quarter, you know the non-refundable portion of ERC. Then number 4, and which, I think I talk about filing procedures, and then the number 3 is the number 4. So those are the common mistakes that you would see when you file ERC. I hope this session helpful, and I want to make sure that you get the necessary depth of the understanding, so knows how far you go in terms of doing your own work on the ERC. You can definitely do it yourself. We have a video on our YouTube channel that tells you how to do it yourself. Our example was very detailed in that video, and people are still commenting on that video being thorough. So you can go follow that. The rule did not change, folks. And if someone tells you that, oh, apply for ERC now because the rule changed, that's not true. It didn't change. But people, when they qualify you, they may exercise different opinions, but you want to make sure that you are relying on professionals to make sure you're qualified or not qualifying, and go with that judgment before you get your money. But once you file, As long as you paid 941 taxes, you will get the refund. And that is guaranteed. It's a refund, right? So it's your money. You can get it. With that, I will conclude today's webinar, folks. I hope you got the taste of ERC, and I hope you get it. If you qualify, go for it. That is the money that helps you to alleviate some cash flow issues you have today. And it is a credit just like a research and the development credit. Have you ever heard the research development credit? And you should look into that too. There's a lot of tax credit, folks. I also have a webinar talk about tax credit, give you a good summary of the small businesses, what kind of tax credit you have. Those are just like ERC. If you don't claim it, you don't have it. But if you qualify, you don't claim it, nobody gonna come back to you goes, oh yeah, I know you qualify, let's claim it now. You may be late. So make sure you understand the tax credit. Tax credit is offsetting your tax dollars. It's a big deal. And $5,000 tax credit equals to almost $25,000 tax deduction. So it's not apple to apple. And don't think of tax deduction is the same thing as tax credit. They're totally different. So make sure you get hold of all the tax credit that you're entitled to. Okay, I will talk to you again on Tuesday. Have a great weekend. Such a good weather, right? Don't catch COVID and just have fun. Okay, bye-bye.